projected 50% increase in restructuring activity across banking, real estate, and manufacturing sectors by Q2 2025, International Competitive Landscape and Expert Insights. Executive Summary. As we approach Q2 2025, a significant increase in restructuring activities, projected at 50%, is anticipated across the banking, real estate, and manufacturing sectors. This surge is attributed to various macroeconomic factors including inflation, rising interest rates, and shifting consumer behaviors. Reports from Deloitte and PwC provide critical insights into the conditions driving this restructuring wave, highlighting both challenges and opportunities for organizations within these sectors. Banking sector outlook. Current challenges. Low growth environment. The banking sector is grappling with a sluggish economic landscape characterized by projected GDP growth of just 1.5% in 2025. Factors contributing to this include rising unemployment and subdued consumer spending. Net interest income decline. Banks are expected to experience a decline in net interest income due to high deposit costs. As interest rates decrease, banks may need to reassess their interest income strategies. Cost management and technology. The pressure on profitability is prompting banks to focus on cost management and modernization of technology to maintain sustainable growth. Optimistic trends. Growth in non-interest income. Deloitte anticipates an increase in non-interest income for banks through expanded M&A activities and investment banking fees. M&A activity. The anticipated rise in mergers and acquisitions signifies a proactive approach to navigating economic uncertainties. Strategic recommendations. Adapt business models. Banks should recalibrate their business models to align with evolving economic conditions. Embrace technology. Investment in technology modernization and AI will be essential for enhancing operational efficiency and driving growth. Commercial real estate CRE dynamics. Market recovery signs. Executive optimism. A survey by Deloitte revealed that 88% of global executives in the CRE sector are optimistic about revenue growth in 2025, marking a significant increase compared to previous years. Anticipated interest rate cuts. Executives expect that upcoming interest rate cuts will restore confidence and stimulate market activity. Continuing concerns. Refinancing risks. Despite optimism, concerns regarding refinancing risks from maturing loans persist, particularly as many loans are set to mature in a high interest rate environment. Market volatility. The CRE sector continues to face challenges related to elevated interest rates and changing workplace occupancy patterns. Strategic recommendations. Focus on sustainable practices. Emphasizing sustainable real estate practices will be crucial in navigating future challenges. Investment in technology. Firms should prioritize technology investments to improve operational efficiencies and respond to evolving market demands. Manufacturing sector trends. Economic pressures. The manufacturing sector is also poised for restructuring, driven by economic conditions that require companies to seek operational efficiencies and reevaluate their strategies. Key considerations. Cautious outlook. Many manufacturing firms are expected to adopt a cautious approach as they realign their operations with market demands. Need for innovation. Emphasizing innovation in manufacturing processes and supply chain management will be essential for maintaining competitiveness. Strategic recommendations. Reassess operational strategies. Manufacturers should continually assess and adjust their operational strategies in response to market shifts. Invest in technology. Embracing Industry 4.0 technologies can drive efficiencies and improve manufacturing outcomes. Common themes across sectors. 1. Macroeconomic pressures. All three sectors face challenges arising from rising interest rates, inflation, and economic uncertainty, which are influencing operational strategies and profitability. 2. Optimism for future growth. Despite these challenges, a shared sense of optimism exists, particularly within the CRE sector. as executives anticipate a recovery phase beginning in 2025. 3. Technological innovation. The need for technological advancement is emphasized across the banking and CRE sectors, with a focus on AI and modernization as key drivers of future success. Timeline of events: 2023 to 2024, economic conditions worsen with rising interest rates and inflation leading to cautious spending and investment across sectors. Late 2024, optimism builds in the CRE sector as executives anticipate increased revenues and improved market conditions. Q2 2025, the projected 50% increase in restructuring activity is expected as organizations recalibrate strategies to adapt to the evolving landscape. Conclusion: the anticipated surge in restructuring activities across the banking, real estate, and manufacturing sectors reflects a complex interplay of economic factors, technological advancements, and shifting market dynamics. Organizations must navigate these changes strategically to optimize their operations and capitalize on emerging opportunities. By embracing innovative practices and adapting to the evolving economic landscape, firms can position themselves for sustainable growth in the years to come. Sources: 1. Deloitte Banking Industry Outlooks www.deloitte.com/us/n/insights/industry/financial services industry outlooks/banking industry outlook.html. 2. Deloitte Commercial Real Estate Outlooks www.deloitte.com/us/n/insights/industry/financial services/commercial real estate outlook.html. 3. PwC Family Office Deals Studies www.pwc.com/gx/n/services/deals/trends.html. The projected 50% increase in restructuring activity across the banking, real estate, and manufacturing sectors by Q2 2025 reveals a complex landscape influenced by various counterintuitive factors. Below are key insights illustrating these dynamics. Banking sector insights. 1. Non-interest income growth versus net interest income decline. While banks are expected to experience a decline in net interest income due to high deposit costs, they anticipate a rise in non-interest income. This includes income from M&A activities and investment banking fees, which might seem contradictory since a challenging economic environment typically compresses all income streams. However, banks are pivoting towards transaction-based revenues, positioning themselves strategically for growth amidst declining traditional interest income. 2. Cost management in a lower rate environment. The expectation of a lower interest rate environment complicates traditional cost management strategies. Banks traditionally focus on loan volume to bolster net interest income, but as rates decline, they must recalibrate their strategies to optimize non-interest income while managing elevated operational costs. This shift suggests that banks may need to invest in technology and talent to sustain profitability, a move that many might predict would further strain budgets rather than stabilize them. 3. Consumer debt and spending dynamics. Despite predictions of an economic slowdown, the sustained increase in consumer debt reaching $17.7 trillion indicates a paradoxical consumer behavior where individuals continue to borrow while savings dwindle. This could lead to increased loan defaults, contradicting the optimism around a lower rate environment potentially boosting mortgage demand. Commercial real estate CRE dynamics. 1. Optimism amid uncertainty. The CRE sector is exhibiting a surge of optimism, with 88% of executives expecting revenue growth in 2025, a significant rise from previous years. This optimism stands in stark contrast to the realities of high interest rates and the ongoing risks associated with maturing loans. The confidence might be seen as overly optimistic given the historical context of economic downturns following periods of heightened expectations. 2. Shift to sustainable practices. The pivot towards sustainable real estate practices is expected to enhance investor confidence. However, The expectation that sustainability will automatically translate into profitability is counterintuitive. The challenge lies in balancing immediate financial returns with long-term sustainable investments, which often require significant upfront costs that may not yield immediate results. 3. Refinancing risks versus anticipated rate cuts. While anticipated interest rate cuts might alleviate some refinancing pressures, the reality is that many firms face a wall of maturities, meaning that even if borrowing costs decrease, the sheer volume of maturing loans may overwhelm the sector. This highlights a lag between policy changes and their tangible effects on market conditions. Manufacturing sector trends. 1. Cautious optimism amid restructuring. The restructuring forecast reflects a strategic realignment in response to evolving market demands. However, the underlying assumption that an increase in restructuring activity will lead to operational efficiencies and better profitability can be misleading. Often, restructuring is a reactive measure that may not yield the desired long-term stability or growth as companies grapple with legacy systems and operational inertia. 2. Efficiency versus investment. Manufacturers are likely to focus on operational efficiencies, but the expectation that this will be achieved without significant investment in technology and workforce upskilling is counterintuitive. In many cases, achieving greater efficiency necessitates upfront investment, which may not be feasible for companies facing immediate financial pressures. Global perspectives and economic factors. 1. Geopolitical stability versus economic growth. The projected economic slowdown in key regions juxtaposed with anticipated monetary policy easing illustrates a paradox where lower rates do not necessarily correlate with robust economic growth. The interplay between geopolitical stability and economic conditions suggests that external shocks may impede recovery even in the face of supportive monetary policies. 2. Investment patterns. The shift towards domestic investments over international opportunities defies the historical trend of seeking growth in emerging markets. This could reflect a growing risk aversion among investors who are now prioritizing familiar markets despite potential returns being lower than those offered by high-growth regions. Conclusion. The anticipated increase in restructuring activity across banking, real estate, and manufacturing is underscored by a series of counterintuitive dynamics. The reliance on non-interest income growth in banking, the optimism in the CRE sector amid refinancing risks, and the cautious strategies in manufacturing all illustrate the complexities of navigating an evolving economic landscape. Organizations must remain adaptable, leveraging technology and strategic planning to optimize operations while confronting the inherent contradictions of the current market environment. The report on the projected 50% increase in restructuring activity across the banking, real estate, and manufacturing sectors by Q2 2025 contains several critical insights that may be overlooked but are significant for stakeholders in these industries. Below are some key points that deserve more attention. 1. Underappreciated restructuring triggers. While many might focus on the macroeconomic factors like inflation and interest rates as the primary drivers for restructuring, the report also hints at deeper systemic issues within these sectors. For example, in banking, the report discusses how high deposit costs are expected to suppress net interest income, which could lead to more aggressive restructuring as banks seek sustainable growth. Stakeholders may underestimate how internal operational inefficiencies, regulatory pressures, and the need for digital transformation will also compel organizations to reassess and restructure their strategies. Significance. Understanding these underlying triggers helps in anticipating not just reactive strategies but proactive changes that organizations will need to implement to remain competitive. Companies that can identify these internal pressures early on may position themselves to capitalize on restructuring opportunities rather than merely reacting to external market pressures. 2. Commercial real estate CRE sentiment shift. The report notes a significant sentiment shift among CRE executives, with 88% expressing optimism for revenue growth in 2025, a dramatic increase from previous years. However, the report also points out that this optimism does not negate the persistent challenges, particularly concerning refinancing risks from maturing loans. Stakeholders might overlook the fine balance between cautious optimism and the reality of financial vulnerabilities. Significance. This sentiment shift may influence investment decisions and market strategies. Understanding this duality allows investors and executives to better gauge market timing and the risk-reward ratio of entering or expanding in the CRE market, particularly if they can hedge against potential refinancing challenges. 3. Technology as a catalyst for change. Both the banking and CRE sectors emphasize the importance of technology in navigating their respective challenges. The banking sector, for instance, is increasingly focused on AI and modernization to enhance operational efficiency, while CRE firms are also looking to leverage technology for better data management and operational efficiencies. Yet, the report suggests that many organizations are still grappling with legacy systems and outdated processes. Significance. Investments in technology can serve as a transformative catalyst for both sectors. Companies that fail to prioritize technological upgrades might find themselves at a competitive disadvantage. Moreover, recognizing the urgency of modernization can guide strategic investments that yield long-term benefits, especially as AI and data analytics play increasingly pivotal roles in decision-making. 4. The Basel III Endgame's implications. The discussion around the Basel III Endgame is crucial yet may be overlooked by many. The reproposal suggests a relaxation of capital requirements which could encourage banks to engage in M&A activities. However, the implications of these regulatory changes on risk management practices and the overall stability of financial institutions are profound and could lead to unintended consequences. Significance. Stakeholders in banking need to closely monitor these regulatory shifts, as they could reshape competitive dynamics and risk appetites within the industry. The potential increase in M&A activities could also lead to greater consolidation, which may alter market landscapes and consumer choices. 5. The role of generative AI in financial services. The report outlines that generative AI could significantly boost banking industry profits, yet many banks are still in the early stages of AI adoption. The potential for generative AI to transform how banks operate, enhancing efficiency, reducing costs, and improving customer experiences, is enormous. Yet the industry is not fully prepared to harness its capabilities. Significance. This presents a critical window of opportunity for banks to invest in AI technologies. Stakeholders who recognize the transformative potential of generative AI and act swiftly may establish a competitive edge. Conversely, those who delay may risk falling behind as the industry evolves. 6. Sustainability and climate resilience in CRE. The report emphasizes the growing importance of sustainability in the CRE sector, with many firms acknowledging the necessity of investing in climate resilience. Yet the challenge remains in balancing these sustainability efforts with financial viability, particularly in an environment where costs are scrutinized. Significance. As environmental regulations tighten and consumer preferences shift towards sustainable practices, firms that proactively adopt and integrate sustainability into their core strategies will likely attract more investment and consumer support. This dual focus on profitability and sustainability will be crucial in building long-term resilience in the CRE sector. 7. The disconnect between talent expectations and corporate culture. The report highlights the impending talent crisis within the CRE industry, where a significant portion of the workforce is approaching retirement. However, the mismatch between the values of the incoming workforce, Gen Z and millennials, and traditional corporate cultures may be overlooked. Significance. Organizations that fail to adapt their cultures to align with the values and expectations of younger talent may struggle to attract and retain the next generation of leaders. This could lead to a skills gap that hampers innovation and growth. Proactive talent management strategies that foster inclusivity and adaptability will be essential for sustainable success. Conclusion: the anticipated increase in restructuring activity across the banking, real estate, and manufacturing sectors presents both challenges and opportunities. Stakeholders who focus on the nuanced insights provided in the report, beyond the surface-level macroeconomic indicators, will be better equipped to navigate this evolving landscape. Recognizing the significance of internal pressures, technological advancements, and the changing workforce dynamics can drive strategic decision-making and foster a resilient approach to future growth. 1. Macroeconomic pressures and sector responses. The projected 50% increase in restructuring activities across banking, real estate, and manufacturing sectors by Q2 2025 is primarily driven by macroeconomic pressures such as rising interest rates, inflation, and subdued GDP growth. The banking sector is particularly vulnerable, facing challenges in net interest income while focusing on sustainable growth strategies. Conversely, the commercial real estate (CRE) sector shows a mixed response, with a notable bounce in executive optimism for revenue growth despite ongoing refinancing risks. An analysis of these pressures reveals differing strategic adaptations within each sector, emphasizing the need for banks and real estate firms to recalibrate their business models to navigate economic headwinds effectively. 2. Technological advancements as a catalyst for restructuring. Both the banking and CRE sectors emphasize the need for technological modernization to enhance operational efficiency and drive growth. Banks are investing heavily in technology and artificial intelligence (AI) to manage costs and boost non-interest income amid declining net interest margins. In the CRE sector, there is a growing recognition of AI's transformative potential, particularly in enhancing decision-making processes and operational efficiencies. The integration of technology is not only vital for immediate restructuring efforts but also serves as a long-term strategy to build resilience against future economic fluctuations. 3. Optimism amidst challenges. A shared sentiment of optimism characterizes the outlook for both the banking and CRE sectors. Despite the macroeconomic challenges, there is a collective belief that growth opportunities will emerge, especially as interest rates are anticipated to decline. For instance, a significant majority of CRE executives express confidence in revenue growth for 2025, indicating a potential recovery after a period of muted performance. This optimism is coupled with strategic shifts towards sustainable practices and capital investments aimed at future-proofing operations, reflecting a broader trend of resilience in the face of adversity. For mergers and acquisitions, M&A is a strategic response. The anticipated surge in restructuring activities is likely to correlate with an increase in M&A activities across sectors, particularly in banking and real estate. The banking sector's focus on enhancing non-interest income through M&A, coupled with CRE companies looking to capitalize on emerging opportunities, suggests that strategic acquisitions will play a crucial role in navigating the evolving landscape, as firms seek to bolster their capabilities and market positions. M&A will serve as a vital tool for achieving growth and adapting to the changing economic environment, signaling a proactive approach to restructuring. 1. The 2008 financial crisis. The global financial crisis that began in 2007 and intensified in 2008 serves as a prominent example of restructuring within the banking and real estate sectors. Triggered by the collapse of the housing bubble in the United States and the subsequent defaults on subprime mortgages, the crisis led to significant losses for banks and financial institutions worldwide. The aftermath saw a wave of restructurings, mergers, and acquisitions as firms sought to stabilize their operations and restore investor confidence. Banks re-evaluated their asset portfolios, leading to a consolidation of the sector, while many real estate companies were forced to reassess their business models. Government interventions such as the Troubled Asset Relief Program (TARP) in the U.S. were also pivotal in facilitating the restructuring process. 2. The dot-com bubble burst 2000 to 2002. The collapse of the Internet bubble at the turn of the century is another historical case of significant restructuring activity. Many technology companies that had rapidly expanded during the late 1990s faced dire financial straits as stock prices plummeted and investment dried up. This led to a wave of bankruptcies, mergers, and acquisitions in the tech sector. Companies were compelled to cut costs, drastically streamline operations, and adapt to the changing market landscape. The aftermath saw a shift in focus from growth at all costs to sustainable profitability, influencing corporate strategies across various sectors including manufacturing and technology. 3. The European sovereign debt crisis 2010 to 2012. Following the global financial crisis, several European countries faced severe debt crises leading to widespread economic instability. Nations like Greece, Ireland, and Portugal required financial bailouts from the European Union and the International Monetary Fund. This period saw extensive restructuring within the banking sector as institutions faced rising non-performing loans and capital shortfalls. The crisis prompted significant reforms in banking regulations and led to mergers and acquisitions as distressed banks sought to stabilize their operations. Additionally, the real estate market in affected countries experienced considerable downturns, leading to restructurings and a re-evaluation of real estate assets and investment strategies. These historical cases illustrate the cyclical nature of economic downturns and the corresponding restructuring activities that arise in various sectors including banking, real estate, and manufacturing. The projected 50% increase in restructuring activity across the banking, real estate, and manufacturing sectors by Q2 2025 is indicative of significant shifts in economic dynamics and industry landscapes. This surge will be influenced by evolving macroeconomic factors, regulatory changes, and technological advancements. Here, we explore the future outlook for each sector based on expert insights and emerging trends. Banking sector outlook. The banking sector is expected to face a challenging yet transformative environment. As banks adapt to a low-growth, lower-rate landscape, they will prioritize sustainable growth strategies. Key trends include: 1. Declining net interest income. With high deposit costs and a lower interest rate environment, banks must reassess their interest income strategies. Deloitte predicts a decline in net interest income, which may push banks to explore alternative revenue streams, particularly in non-interest income such as investment banking fees and mergers and acquisitions (M&A). 2. Focus on technology and innovation. Banks will increasingly invest in technology modernization and artificial intelligence (AI) to enhance operational efficiency and customer service. The promise of AI is not just in automation but also in creating personalized banking experiences, fraud detection, and predictive analytics. 3. M&A activity. The anticipated regulatory changes from the Basel III Endgame suggest a more favorable environment for M&A, particularly among regional and mid-size banks seeking to consolidate and improve their competitive positions. 4. Credit quality management. As credit quality normalizes post-pandemic, banks will need to focus on managing rising delinquencies in consumer loans, particularly credit cards and auto loans, amidst a backdrop of increasing unemployment and consumer debt levels. Commercial real estate (CRE) dynamics. The CRE sector is witnessing a cautious yet optimistic revival, with various factors contributing to increased confidence. 1. Rising optimism for revenue growth. A significant shift in sentiment is noted, with 88% of global executives expressing expectations for revenue growth in 2025, compared to a more pessimistic outlook in previous years. This optimism is driven by anticipated interest rate cuts and a focus on sustainable real estate practices. 2. Shift in property investment focus. Investors are likely to prioritize sectors such as industrial, logistics, and digital economy properties, including data centers, which align with ongoing trends in e-commerce and technology adoption. However, the office sector remains under scrutiny due to changing work dynamics and increased vacancies. 3. Technology investments in CRE. There is a strong push towards digital transformation, with 81% of executives indicating a focus on data and technology investments. This includes harnessing AI for property management, predictive analytics for market trends, and enhancing tenant relationships. For sustainability initiatives, as climate change concerns grow, real estate companies will increasingly invest in sustainable practices, including energy-efficient retrofits and compliance with stricter regulations. Manufacturing sector trends. The manufacturing sector, while less highlighted in current reports, is poised for significant restructuring as companies adapt to changing market demands and economic pressures. 1. Operational efficiency focus. Manufacturers are likely to seek efficiencies through automation and digital transformation to combat rising costs and labor shortages. The integration of AI and IoT technologies will be essential in optimizing production processes. 2. Supply chain resilience. Companies will continue to re-evaluate their supply chains to mitigate risks exposed during the pandemic. The trend towards nearshoring and localizing supply chains will influence investment decisions and operational strategies. 3. Sustainability as a driver. Similar to the CRE sector, manufacturing will increasingly embrace sustainability. Regulatory pressures and consumer preferences for environmentally friendly products will drive investments in green technologies and sustainable practices. Common themes across sectors. 1. Macroeconomic pressures. All sectors will navigate challenges posed by inflation, interest rate fluctuations, and geopolitical uncertainties. This environment necessitates strategic recalibrations to maintain profitability. 2. Technological advancements. The integration of technology and AI across sectors is paramount. Organizations will leverage these tools to enhance operational efficiency, improve customer experiences, and drive innovation. 3. Focus on sustainable practices. As environmental concerns become central to business strategies, companies will prioritize sustainability in their operations and investments. 4. Increased M&A activity. The restructuring landscape will likely see heightened M&A activity as companies seek to optimize their portfolios, enhance capabilities, and respond to market pressures. Conclusion. The projected increase in restructuring activity reflects a complex interplay of economic factors, technological advancements, and shifting market dynamics. Organizations in banking, real estate, and manufacturing must navigate these changes strategically to optimize operations, leverage emerging opportunities, and position themselves for sustainable growth in the evolving landscape. By 2025, those that adapt proactively will not only survive but thrive in a competitive and rapidly changing environment.